Welcome to 2025. It's been a while since I've seen you, but I'm happy to be back in front of you all and to reaffirm our strategy and point out the core competencies that we're going to use here in 2025. We had a challenging 2024, to say the least. I appreciate you riding along with us. I apologize for that, and I do believe that things are about to go our way. I keep saying that. For those of you that hang in, you're going to be rewarded. Those that maybe flip strategies right here at all-time high valuations of the stock market are going to have a hard time in 2025 is my belief. So let's jump into some of the challenges. Why have we had a challenging time? I'm going to show you with some of the charts. Basically, stocks and interest rates and bonds are all intertwined to a certain degree, but when interest rates go up, you should have rates going up, equities going down, and we've actually got something quite opposite of that that's never happened in our history. So let's just dive into some charts. I want you to know that I do still have 100% faith. I use my money invested the same exact way you do. I'm having a hard time just like you are. That's going to change, and I'll show you why. So let's take a look at the market itself. We're going to look at the SPY chart, SPY, and today is January 8th. Let's just look at this chart, see where we sit right now, and we'll go from there. So in this chart, we've got a 200-day moving average. That's always considered your line in the sand. That is the red line. If any of the other lines, being the black or blue line, cross the red line, we're in major trouble. That's when recessions and major pullbacks start. But right now, we're looking for the beginning of the pullback to start. You will notice the black line that is circled here, the area circled with the blue circle. The black line is about to cross through the blue. You will see that the red candles, which are daily market activity, are below the purple, meaning high probability black line is going through blue, which is our very first step to market correction and the path to good times for us. We'll revisit this over time. We've had some data come out this morning about employment. More so, I think what's going to be really important to this is what happens to interest rates, and that's why that is the theme of our email this week. So let's take a look. Since the Fed has been cutting rates, the 10-year interest rate, which is what everything in the world is tied to, credit card loans, car loans, home loans, since they've been cutting rates, that rate has actually went to the moon, which is something we don't see much. So let's look at that slide now. This slide's pretty cut and dry. You'll see the red arrow pointing to when the Fed cut rates by 50 basis points. Now keep in mind, when they cut rates, the 10-year rate should begin to fall. As soon as they cut rates, the 10-year started to rise. When they cut rates this last time, December, rates really have taken off. So this is just not a normal thing. That's why I tell you, our strategy, I feel, is on point. The market is not acting correctly right now. In our second slide, this is from Apollo Investment Management, to give them credit, a nationally respected investment firm. They're pointing out the same topics that we're bringing to you today, saying that this is not normal behavior. The blue line here shows when the Fed starts cutting rates, what the average cycle looks like, meaning the Fed cuts rates, the 10-year should go down. That's what the blue line's representing. You'll notice there's a vertical line right in the middle. That is when the Fed started cutting rates. So what's happening this time? As soon as the Fed started cutting rates, the 10-year rate started going to the moon. That's a real problem. Basically, it just says that we're playing with fire. There's some kind of recessionary type of play at hand. The Fed really shouldn't be cutting rates. They probably were doing it for political reasons. Now their back's against the wall. What's going to happen next? Probably some fireworks. Okay, so this last slide here concerning rates. Remember, the 10-year interest rate drives everything. So if you're a small business, you have to go borrow money. You need that 10-year rate to be low. The higher this 10-year goes, the more bankruptcies we see. 2024 had the most corporate bankruptcies of, I believe, all time, if not the last 20 years, and more than COVID. Believe that. The 10-year rate is extremely high and restrictive right now. It's challenging. So let's look at a chart just about the 10-year rate And what can we see concerning the direction of the future of rates? What do I believe? What does our firm, our research believe and show us? So in this chart, you'll notice the blue line across the top goes back to the highest point that the 10-year rate was. And that was back the end of 2023. And we started having conversations about rate cuts and it started to come down. But let's just keep this simple. It was 5% in 2023, started to come down. You see it move around. We have drawn in this trend line. This yellow line shows a trend that this is tending to follow, either bouncing off of or from support or resistance. What we're seeing here on the very right side, you're seeing when they first started cutting rates is when this bottom began to be the bottom and rates started to go up. We are now sitting at roughly 4.7% today. If we get over 4.7 again today, which we were this morning, I believe we will with the 30-year bond auction that's coming at noon. Equities are really going to be pressured. Equities have been pressured, but not very much at this point. We expect the 10-year here to have the possibility of getting back up to that blue trend line and bouncing off of that and coming back down. So you're sitting here saying, Jeremy, all fine and dandy. Why does that matter? How are we going to benefit from that? In this chart, you will see that as the blue line has went up, this is just since the Fed started cutting rates here, as the blue line goes up, which is the 10-year rate, here it's illustrated by an investment called TNX, but it's the 10-year rate. As that blue line goes up, red line goes down. Red line is bonds. Why have we had a challenge? And every retiree and every conservative investor in this world had a challenge. Bonds are going down as rates go up, and rates really shouldn't be going up here. So what we have done, fortunately, we were not overly exposed to bonds, but we are beginning to buy bonds. What you'll see, we come back to the 5% theory. If this chart goes to 5% on the 10-year yield, we will buy as many bonds as we can buy, and we will get paid 5 to 8% in dividend on those bonds, and we will watch them grow by 5, 10, 15%, whatever it may be over the next year, and we will have a very safe, well-performing portfolio. Our biggest enemy is the 10-year rate continuing to climb without equities falling. Somebody's holding up the equities. My assumption is that somebody will stop doing that on January 20th. When equities go down and bonds are down, we're going to be able to do really well. We'll sell off our shorts that are going to pay us on the equities going down, and we will buy a lot of bonds. I know it's complicated, but things are very well lined up for us to do great this year. In summary of the whole conversation here, I believe that we are knocking on the door to a 1929 type of recession. I know that's crazy to say. I don't want to be a fearmonger. I don't want everybody scared, but even Donald Trump has put that out there on Truth Media that this administration that was in there has set up a lot of landmines. We continue to try to share that info with you. I hope that we're conveying it well. We need to make sure that we benefit when the market goes down. The reason we're not, market has not went down.